I don't own gold because I think it might go from 2,600 to 3,000. That's why I don't own it for that reason. Because I'm afraid it's going to go to 10,000. I own it because gold historically has been a store of value during periods of time when people were concerned about the maintenance of their purchasing power in fiat instruments. And when I consider the debt problem that you and I just discussed relative to the national income, I don't believe there's any way in the world that the US dollar can maintain its purchasing power. That's why I own gold. Do I know or care if it's going to $3,000? Not the faintest concern, not the faintest interest, neither.
Gold has long been recognized as a dependable hedge against economic volatility, offering stability to investors during market swings. Its sustained appreciation over time underscores its role as a valuable asset in preserving wealth. RickRule, president and CEO of Rule Investment Media, highlights gold's exceptional long-term performance, noting its rise from $253 per ounce in 2000 to approximately $2,600 today. This sevenfold increase reflects an annual compounded growth rate of 8.2%, firmly maintaining its purchasing power over 2 decades. This remarkable performance comes when traditional economic indicators present a mixed global picture. While the U.S. economy rebounded strongly post-pandemic, with robust employment figures and rising wages, many other economies struggled. Countries like China teetered on the brink of recession, while others faced stagnation. In such uncertain environments, gold's role as a haven remains pivotal, often becoming a priority asset in regions facing hyperinflation and currency instability. Despite its resilience, gold remains underrepresented in U.S. investment portfolios. According to RickRule, only 0.5% of U.S. investment assets are allocated to precious metals, far below the 40-year historical average of 2%, as reported by J.P. Chase. This gap highlights the untapped potential in the precious metals market as gold diverges from traditional economic patterns. Notably, gold has recently broken its usual correlation with real interest rates. Historically, gold prices decline when real interest rates rise. However, this relationship has weakened, notably as U.S. federal interest rates flattened and fell in 2024. This shift underscores gold's evolving appeal as an investment, even in a changing economic landscape. As global uncertainties persist, gold's enduring strength and unique market dynamics reinforce its position as a critical component of a diversified investment strategy. Whether as a hedge against inflation or a safeguard during economic turbulence, gold remains a trusted asset for wealth preservation. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Gold has done a great job, and I'm delighted. Well, I'll give you some arithmetic. If I was on Adam Taggart's show, and one of his readers said to me, "Rick, when is the gold price finally going to move?" I would say to that person, I'd be old and sage, it's going to move in the year 2000. In the year 2000, it was at $253 an ounce. Now it's at $2,600. In other words, it's up, what, sevenfold? Gold has increased by almost 8.5% compounded for 24 years. It's done exactly what it was supposed to do. It's protected by purchasing power for 24 years. So when you're asking me when gold going to move, 24 years ago. What I really like about it from an investment perspective is that it has this wonderful track record, which nobody cares about. The market share of precious metals and precious metal securities in the U.S. market, the market that I know the best, is less than 0.5%. Less than 0.5% of savings and investment assets in the United States are precious metals related. The 4-decade mean, according to J.P. Chase, not some old bald gold bug, J.P. Chase, is that the market share of precious metals and precious metals securities over the last 40 years in the U.S. market has been 2%. Gold doesn't need to whip the U.S. dollar. Gold doesn't need to break the treasury market. All it has to do is revert to mean. If it reverts to mean, the market share in the U.S. market grows fourfold. Now, can you imagine what a fourfold increase in demand for gold and gold stocks in a market that controls 23% of the savings and investment assets in the world would do to the gold price? If you look at a global market for savings and investments at the $750 trillion level, gold is a sideshow and Bitcoin is a sideshow. They don't matter. The circumstance that will cause the gold price to move is a circumstance where perhaps Bitcoin can be accommodated in the move too. Gold is a store of value and a medium of exchange. Bitcoin is a network and a transfer mechanism. So I think at their heart, they're different asset classes. If you ask people to form an opinion as to value, they have to do work. They have to think, not feel. And perhaps most people would rather feel than think. The aggregate debt of the U.S. government and the ability to service the debt, and I'm concerned. And I expressed that concern from the podium here, and I watched the audience nod off, saying, would you please give me 5 gold stocks that will triple in next quarter? I don't care about the state of the world. We talked earlier about the unfair division of economic gain. It's unfair because some people work harder, take more risks, and think better. That's the way it works. Sadly, people resent that out.
Throughout its history, the United States has used inflation to manage its national debt by reducing the real value of its obligations. RickRule notes a particularly stark example in the 1970s, when the dollar's purchasing power fell by 75%, and gold prices skyrocketed from $35 to $850 per ounce. A similar pattern could emerge, yet many remain unaware of this mechanism and its potential impact. Earlier examples of inflation-driven debt reduction include the post-World War II period. In 1946 and 1947, as the U.S. recovered from the war and lifted wartime price controls, inflation rates surged to 12.9% and 11%, respectively. This inflationary burst was vital in reducing the debt-to-GDP ratio from 119% in 1946 to 92% by 1948. This rapid adjustment highlights how inflation can effectively shrink debt burdens when nominal obligations remain unchanged. Inflationary pressures reappeared more gradually in the 1960s and 1970s. From a modest 1.1% in 1963, inflation peaked at 9.3% in 1975 and 9.5% in 1981. During the early 1970s, market expectations were slow to adapt, and the yield on the 10-year Treasury only kept pace with inflation as measured by the GDP deflator. This lag resulted in negative real yields for a time, effectively allowing the government to borrow at rates that eroded the value of its debt. The parallels between these historical instances and the present are striking. With debt levels rising and economic pressures mounting, inflation could again become a critical lever for reducing the real burden of national obligations. However, as RickRule suggests, few recognize or prepare for the potential implications of such a scenario. Let's get back to the interview.
Let's unpack that, first of all. The probability that Trump actually cuts spending. When you look at the range of campaign promises that he made, it's obvious that he wasn't really campaigning on cutting spending. He was campaigning perhaps on cutting spending to constituents that didn't vote for him, but that's not the same thing. If you were as old as I, and I realize you're not, you would have experienced this once before during the Reagan Revolution. Reagan came to office with a much stronger mandate than Trump to dismantle government, reduce the size. There's a wonderful book called The Triumph of Politics by David Stockman that describes the derailment of the Reagan Revolution within 180 days of them taking office. Think about empowering a government agency, the Department of Government Efficiency. Yes, you're creating a government department to reduce government departments. Think about that. The probability of them achieving that, I believe, is zero. As to your first question, how do we get out of this? I think, unfortunately, the answer to that is clear from history. We faced the same circumstance, although less dire, in the decade of the 1970s. And what we did is we honored our nominal obligations. In other words, some old codger like me, who's getting, I don't know what I get, $4,000 a month in Social Security, I'll continue to get $4,000 a month, but $4,000 won't buy $4,000. We will honor the nominal amount of our obligations, but will inflate away the net present value of the obligations. The U.S. government themselves suggest that in the decade of the 1970s, the last time we faced this circumstance, the purchasing power of the U.S. dollar was reduced by 75%. Not coincidentally, during that period, the gold price went from $35 an ounce to $850 an ounce. Yes, the two events were related. The only way that I understand that we get ourselves out of our debt crisis while politically honoring the nominal value of our obligations is to inflate away the net present value of those obligations. Sadly, in this circumstance, I believe that past is prologue. I also believe, unfortunately, that most Americans and most Canadians aren't even aware of the narrative around the problem. Never mind.
Gold's enduring appeal lies in its ability to preserve wealth and hedge against economic challenges. Its consistent growth over the years, despite global economic turbulence, highlights its unique role in diversifying investment portfolios. As economic trends shift and traditional financial strategies face limitations, understanding gold's potential as a strategic asset becomes increasingly apparent. In a world of mounting uncertainties, gold remains a symbol of stability and financial resilience. How do you view gold's role in safeguarding wealth amidst economic fluctuations? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.